Diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and if all you have to achieve is average, it may preserve your job, but it's a confession, in our view, that you don't really understand the businesses that you own.
Well, what do you think about that? Personally, I think Warren's right. If you're going to spend any time at it, you need to become a specialist, not a generalist. You need to study those companies that are going to make a lot of money in the next 3 to 5 years. And I don't think there's any argument that that's going to be artificial intelligence, machine learning, and then quantum computing. And what you need to do is spend your time studying it, or have someone who advises you that is studying it, so that you make the best of your investment. Because there's no question in my mind, and I hope in your mind, that the next 3 to 5 years are going to be the time of greatest change in mankind, and there are going to be companies that are going to profit on this extraordinarily. Again, I've mentioned before, I'm reading a book called The Chip Wars that is teaching me so much about super micro computers and semiconductors, that this is where we need to invest. And that's where I'm spending my time. And I want to share my findings with you.
Best of Us Investors presents Kerry Griegmeyer.
So, okay, let's agree with Warren. Diversification is madness. To prove it to you, I want to bring back up some charts I've shown you in the past. This is a chart of a non-diversified portfolio of 13 stocks that were a part of the data revolution, the internet revolution, from 1999 through 2023. And you're going to see names like Apple, Microsoft, Amazon, NVIDIA, Google, ASML, Marvel, AMD, Broadcom, Meta, Supermacro Computer, AEHR, and Rambus. And those companies, those 13 companies, had an average rate of return from their inception of 38%. That's 13 companies, annual average rate of return, 38%. Then let's look a little bit further. Since IPO, here's Apple, Microsoft, Amazon, NVIDIA, Google, and Meta. Those, 1, 2, 3, 4, 5, 6 companies have had an average rate of return since their IPO of 45%. I just want to stir this pot up a little bit more and put Symbiotics in there, SYM, Tesla, and Vertiv. And then we'll look for some more. But we do not need more than 20 stocks in our portfolio, and we can expect somewhere between a 38 and 45% return. That is not diversification. So throw that out. Throw those ETFs out that you say, okay, I'm going to buy a tech ETF. No, because you're going to bring a lot of garbage with you. And it's just like Warren said, to carry a diversified portfolio is basically admitting you don't know what you're doing. You don't know how to pick strong companies. As he said, there aren't that many strong companies that are going to take advantage of what's coming to us now. They aren't well managed. They aren't in the right position. They aren't financially sound, and therefore they will not succeed, or they will not succeed to our expectations. And our expectations are in excess of 33%. We do not want the Dow Dow at an average rate of 7, 8, 9%, or the S&P at an average rate of return of 11%. We want 30 to 35 to 45, even in some cases 150%. When we do our research, we do our reading, we come to an understanding of what is about to happen, how it's going to happen, and who's going to bring home the bacon for us. That's what I'm going to do. I don't have that many more years left. So I'm going to spend my time researching, understanding, reading, and then being in a position to take advantage of the next big change. And that's going to be quantum computing. I'm going to read more about it. I'm going to understand it. And then I'm going to invest in my education by gathering the information provided to me through the internet of other people's opinions and understandings. So I become knowledgeable. I'm going to become the best heart surgeon. What does this all look like? It looks just like this, and this is what you'll find on my website every day. It's my Bus 12 and Bus 13 portfolio manager. It consists of 22 stocks. It shows their current price, and that updates every 20 minutes. And then it shows their Zacks rating, whether it's a strong buy, a hold, a sell, or a strong sell. Then you see my portfolio allocation, how much of my portfolio percentage-wise is in each one of these stocks. Then I show you my target buy price, the price at which I want to buy this stock as it comes down. And where I get that is off of my Trading Views charts with the add-on that I put in. This is the support level. This is the green line that shows you this is where Wall Street has put in buy orders should the stock drop down. And this is the lower end of its trading range. So that's how I determine that price. Then I come over here to the far end and I say, okay, if that's where I want to buy it, where is my goal to sell it? And I use, again, the opposite, the red line on the Trading Views. That's where all the sell orders are that Wall Street has put in, that if such and such a stock hits this level, that's where we want to sell it. So that's the top of the range that they feel the stock is going to go. I then also add to that the price at which the analysts, the Wall Street analysts, have said through Zacks that they feel the stock will reach in the coming months. So I combine those two numbers, I divide it by 2, that gives me the average. I then go in and say, okay, if it does hit that high, that sell price that I'm projecting, and I've bought it at the buy price that I projected, then the difference is what I'm going to make. Okay? Is that going to be written in stone and accurate? No. But it gives me a target. It gives me a method by which to manage my portfolio and then to potentially reallocate. Because as you will see, some of these stocks are projecting a 21% return and others are projecting a 155%. So my allocation will change as those numbers change, and every day I get data to feed it. That's what I'm doing. I'm not going to be a general practitioner. No, I'm going to be a brain surgeon. I'm going to be a heart surgeon. I'm going to be a cancer specialist because I'm going to be the most knowledgeable person in the game. Now, if you want to duplicate, I'll show you how to do it. Just like I showed you, you need to subscribe to Zacks. You need to subscribe to Trading Views. You need to build in all the add-ons that you can so that you get the information you need. Or your other choice is to join my tribe, and you do that by getting on the bus. Come to bestofusinvestors.com, find the link where you can join our platinum platform. You'll also have the opportunity to meet Mark, and Mark will teach you what the moving averages are and what the relative strength index is, and you will gain your knowledge. So eventually, you can wean yourself off of Best of Us Investors and do this for yourself and make a good living doing it. It just takes a lot of work. I'm willing to do the work. I'm willing to share it with you. I'm willing to pay for it up front. You make the decision what you want to do from here on.